So first we have a simple.
Before we go into that, also one thing that we are introducing that is new is the term structure. We've added a new chart, and we also added past term structure. So you can see the term structure today versus yesterday, 5 days ago, and 30 days ago. So that can give you like a good understanding if the market is changing, if the term structure is shifting, moving towards contango backwardation and so on, and how can that be leveraged. So yeah.
And so really those two things combined, term structure plus skew, it really helps us think about where options are relatively cheap and rich. As traders, we always try to have this idea of, what's fair value and then what's relatively cheap, what's relatively expensive right now, particularly when you're a market maker. And so together that gives the skew and the term structure give you the whole sense of, hey, if I want to buy options, I want to go find where I think the relatively cheapest place to buy options is in the, in the volatility surface using both term structure and skew. If I want to sell options, vice versa, then I want to find the most expensive implied volatility to sell. So right now, looking at term structure, we can see a pretty consistent story. Over the last day or so, things have kind of become more middling. There's not a strong signal from this, but I'm going to just focus on actually where we were about a day ago, the red dotted line down there. So, when markets have periods of really low realized volatility, but market makers, don't want to basically sell longer dated options too cheap because they're concerned about a big spike. We start to see what we saw in the last couple of days, which was this big, sometimes called contango, but an upward sloping term structure. So you could see that, and we saw that across the board. We were seeing these kind of really low short-term implied volatilities that were going up over time. So again, the market's telling us that, hey, volatility is really low right now, but it's not necessarily going to stay that way. And as we go further out on the expiration timeline, then we're going to start to see implied volatility go up. And so again, if we're thinking about buying options, typically we're going to get options much cheaper if we buy the very short dated stuff. And if we want to get higher prices for the options we sell, we're going to want to look at long dated.
I think now, Ryan, if how can we combine, and we're just going to do this one last example, but then we also have a session on July 24th just to specifically talk about skews. But here you see obviously two charts, which is the at the money term structure and the skew, 3-month skew for NVIDIA. So how can you actually use this chart and what can you derive from it?
Yeah, absolutely. So taking a look at NVIDIA. So what can we see here? So when we look at the skew, what we can see is that after a brief dip, the puts have gotten really expensive on NVIDIA over the time period that's in question, or at least relatively expensive compared to they're at the top end of the range. So not a great time to be buying puts as a trader. So there's a few different strategies that we can look at here. So kind of beginning level bull strategy. And again, I want to emphasize that these markets don't necessarily tell you that there's one trade, but depending on what your basic outlook is on the market, you can almost always find an option structure from the skew that'll support your position. So for example, if you're bullish NVIDIA, what can you do with this? Well, when puts are relatively high, it might be a good time to actually sell puts to get exposure to NVIDIA. You get a long, effectively a long bias by selling those relatively expensive puts. And you could also sell the puts and buy the calls, if you wanted to get some leverage. So you might be able to get cheaper leverage if you wanted to do, basically get more exposure to NVIDIA than you would otherwise by selling puts and buying calls. And you could probably do that more times than you'd feel comfortable buying underlying contracts. Plus that would help insulate you from some of the noise and the short-term choppiness if you just wanted to be exposed for the big moves. But let's say you're bearish. This is a little bit more advanced strategy, but knowing that the put skew is the way it is, so those out of the money puts are going to be much more expensive, and the calls are going to be relatively cheaper. We could look at buying an in the money put, which will actually use this is a bit more advanced, but uses the implied volatility from the calls because it's in the money. And we could look at buying an in the money put and selling an out of the money put. And so basically creating a put spread, but a put spread that's favorable to us because the put that we're selling is going to be higher implied volatility. So we'll collect relatively more premium. We will have to pay a premium to buy this put spread, but it should be relatively cheap to express a bearish view on NVIDIA, and probably a lot safer than, say, shorting the stock. What if you're just a technical trader and you're not here to trade options at all? What can we say from this? I think you can actually get a lot out of these skews, which is why I'm guessing this is such a popular request. If I'm trading NVIDIA right now and I was long, I would personally be lowering my kind of take profit targets. And the reason being is that the market does not seem to be pricing in the risk of a huge spike, a hugely volatile spike. I know that's been happening for an NVIDIA for a while now, but it seems like the market's starting to say that the risk is becoming a bit more symmetrical. So after previously being a stock where the kind of explosive movement was to the upside, it seems that now the market's saying, well, it could be pretty explosive up or down now, suggesting NVIDIA has become at least a bit more fairly priced. So if I was long NVIDIA and working some take profit targets, I would probably tighten those up. I wouldn't be quite as aggressive or ambitious, thinking, oh, this thing's going to go to the moon. I'd be in and out quicker, because you gotta increase the kind of probability of a downside sell-off relative to the rally.